Welcome to the Vaughan Nelson podcast. Today is the second quarter 2026 Vaughan Nelson Emerging Markets Recap. And with me today is Portfolio Manager Kevin Ross. Welcome, Kevin.
Thanks, Dan. It's great to be here.
Good. Well, hey, how about before even getting to the quarter, why don't we just briefly remind our listeners of the investment philosophy, how capital allocation framework shapes the way that you are building out the portfolio?
Sure. So, at the core, we believe today's capital allocation decisions drive tomorrow's returns. The capital allocation framework evaluates where and how capital is being deployed across our universe of securities. We measure not just the amount of investment, but the expected return on that investment, given underlying competitive dynamics, the industry's capacity, and the availability of capital. We prefer companies investing into opportunities where future returns are improving and avoid businesses deploying capital into increasingly competitive or structurally low returning markets. One point to emphasize up front, because it's part of this quarter's story, our framework is forward looking. We are anchored to where returns are going, not to necessarily where they have been, and not to where our positions have been. So when the evidence changes, the portfolio changes with it. Every portfolio decision, from the initial purchase to position sizing to our eventual exit, flows from these forward looking assessments.
All right, great. Well, thanks. And let's loop on to the quarter. What were some of the broader market forces that shaped the quarter, and how did the macro environment cut both ways for the portfolio?
Two big forces defined the quarter, and they both interacted. The first was a de escalation in the Middle East. After the conflict driven volatility that dominated the first quarter, tensions eased meaningfully, and crude oil retraced back towards pre conflict levels from earlier in the year. That recovery and risk appetite ignited a global rally and removed the energy tailwind that had supported parts of our positioning and energy linked markets in the Middle East and across Latin America, which as a result underperformed the broader index during the period. The second and dominant force was a continued acceleration of capital flowing into the AI ecosystem. Earlier this year, we expected financing constraints to moderate the pace of investment as hyperscalers, neo cloud providers, and infrastructure companies funded increasingly ambitious buildouts. Instead, the opposite occurred. Hyperscalers continued raising capital expenditures guidance. Aggregate 2026 commitments now sit in the range of $600 to $700 billion, supported by substantial equity and debt raises. Visibility into AI enabled devices improved, and new product generations are ramping at nearly twice the pace of prior cycles. The rally was earnings driven rather than multiple driven. The largest share price moves in Korea and Taiwan were accompanied by earnings growth that outpaced the moves in the stocks themselves. These developments reinforce our conviction that AI is expanding well beyond semiconductors into networking, communications infrastructure, intelligent edge devices, and enterprise software. At the same time, the rally has been strikingly narrow. China was negative for a second consecutive quarter, driven by retail and auto weakness, and consequently, the domestically oriented markets lag significantly. For a diversified capital allocation driven portfolio like ours, that narrowness was an important headwind for the performance during the quarter.
And now let's drill down a little bit into companies, sectors. Which of those contributed the most to performance, and where did you see the biggest challenges?
So, looking at the industry level, our positioning in media and entertainment, automobiles and components, and consumer services contributed, while underweights and stock selection in tech hardware and equipment, semiconductors and semiconductor equipment, and consumer discretionary detracted during the quarter. The latter group reflecting the underweight positioning that we've discussed. Avoided industries added material performance during the period and remains one of the most consistent sources of value the framework generates. Among our individual holdings, some of the top contributors were Nora Technology Group, Tencent Holdings, and JSW Infrastructure. Nora benefited from China's accelerating domestic semiconductor equipment cycle, Tencent from improving AI driven monetization across its ecosystem, and JSW from continued throughput growth and operating leverage across its port network. It's worth noting that the financials broadly strengthened late in the quarter, most notably in India, as the rally began showing early signs of broadening beyond the AI trade. The largest detractors were SK Hynix, B3, and Alibaba. SK Hynix detracted in a relative sense. B3 gave back some of its strong first quarter gains as Brazilian market activity moderated, And Alibaba, which we exited during the quarter, lagged alongside broader China consumer weakness.
And can you go deeper on Noro, top contributor? What did that illustrate about how capital allocation decisions play out?
Nora is a great example of our framework identifying a multi-year capital deployment story where the industry setup is one of the main drivers. The company develops semiconductor manufacturing equipment used throughout the wafer fabrication process, including deposition, etching, thermal processing. And it has been investing consistently to expand its product portfolio and push into increasingly advanced process technologies. What, in our view, makes the return on the investment compelling is that the demand environment it's selling into. China's domestic semiconductor manufacturing capacity continues to expand, driven by both commercial demand and geopolitical priorities around supply chain self sufficiency and government incentives. Equipment content per wafer is rising and increasing as processes become more complex, which means Nora's addressable spend grows faster than the overall wafer capacity growth. And the acceleration in global AI investment adds a further layer. Sustained semiconductor capex worldwide lifts the entire equipment ecosystem, while export restrictions on foreign tool makers effectively reserves a growing share of the domestic market for local champions such as Nora. From an overall CAF framework perspective, we think this is a company deploying capital into R&D and capacity at precisely the moment when the return on that capital is structurally improving. It has a protected demand pool, rising content per unit, and constrained competition. This is a setup that we find to be very attractive in the portfolio.
And looking back at the quarter, you made a number of portfolio changes. Can you walk us through the exits, what you were selling, why you were selling them?
Sure, we exited 11 positions during the quarter. The decisions fell into three distinct categories. We ended the quarter with about 21 holdings, which is concentrated in line with our targets. The first category was our Middle East cluster, so names like Saudi Aramco, Saudi National Bank, and SABIC. Listeners will recall we added several of these names earlier in the year or last year, and they increased during the sell off and they rose during the quarter, resulting from the de escalation of the geopolitical tensions and the oil price retracing to pre conflict levels. And we thought that the forward return potential had compressed meaningfully, so we pursued other opportunities within the portfolio. The second category was our reallocation towards the expanding AI opportunity set. Alibaba, Samsung Biologic, Komatsu, and Ivanhoe Mines were exited not because the business is deteriorating meaningfully, but because our estimates of forward returns across the AI value chain improved so materially that the opportunity costs of continuing to hold on to them increased. In Alibaba's case specifically, the capital reallocation story we owned it for was progressing, but the returns are materializing more slowly than what we felt was available to us in other areas.
And now looking ahead, where do you see the most compelling opportunities, and what are the risks that could disrupt that picture?
The capital allocation trends are evolving rapidly, particularly within the AI ecosystem. The most important realization this quarter was that financing capacity is significantly stronger than anticipated, extending both the duration and the breadth of the AI investment cycle. That improves our outlook across the value chain, from semiconductor equipment and networking to communications, infrastructure, enterprise software, and intelligent devices, and our positioning now reflects that. We're also watching for the rally to broaden. Financials, particularly in India, strengthened late in the quarter, and valuations across much of the non AI opportunity set remain undemanding. The capital allocation framework is inherently forward looking, emphasizing where returns are improving rather than where they have been historically. As capital allocation trends shift across companies and industries, the portfolio will evolve accordingly. This flexibility allows a strategy to reallocate towards opportunities with the highest prospective returns while exiting situations where incremental investment is becoming less attractive.
Great. Well, thank you so much for that, Kevin. And now we will move to returns in the second quarter of 2026. The Vaughan Nelson Emerging Market Strategy returned 6.87% gross, 6.58% net, and the MSCI Emerging Markets Index returned 24.05%, which brings the year-to-date return for the Vaughan Nelson Emerging Market Strategy to 14.2% gross, 13.58% net, and the MSCI Emerging Market Index is at 23.85%, Over the past year, the Vaughan Nelson Emerging Market Strategy has returned 41.53% gross, 40.03% net, and the MSCI Emerging Markets Index is at 43.51%. And last, over the life of the strategy, the Vaughan Nelson Emerging Market Strategy has returned 25.57% gross, 24.22% net, and the MSCI Emerging Markets Index is at 27.82. And with that, Kevin, that's a wrap on the second quarter. So thank you so much, and we'll have you back soon.
Sounds good, Dan. See you next quarter.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.